What if I told you that doing less could actually help you earn more from your investments? Yes, in the world of mutual funds, sometimes the simplest option is also the smartest one. Today we'll break down exactly why passive mutual funds are often better than actively managed funds. With real numbers, clear examples, and zero jargon. Let's simplify investing. Hello guys, welcome back to FinSetWealth, where we keep saving, investing, and wealth building simple and real. Let me ask you a question. If you invest 10 lakhs today, how much difference would it make if you choose an active fund versus a passive one? What if I told you that choosing the wrong one could cost you over 20 lakhs in the long run? Yes, you heard it right. 20 lakhs. Stick with me and I'll show you exactly how. Let's start with the basics. Passive funds simply copy an index like Nifty 50, Sensex, or S&P 500. There's no fund manager picking stocks, no guesswork, it just mirrors the market. Active funds, on the other hand, have a fund manager trying to beat the market. They pick stocks, they buy, they sell, and often they change strategy. Sounds smart, right? But here's where it gets interesting. Let's assume you invest 10 lakhs for 20 years. In a passive fund, you might earn 12% per year minus a small expense, say 0.2%. That's 11.8% net return. Whereas in an active fund, with the same 12% gross return, the expense ratio is higher, around 2%. So your net return drops to 10%. Now let's look at the final value after 20 years. Passive fund, 95.5 lakhs. Active fund, 67.2 lakhs. That's a difference of 28.3 lakh. And that's just because of fees. Let's bust a big myth. You might think, well, active funds charge more, but they give better returns, right? Not really. According to the Spiva India scorecard, over the last 5 years, 85% of active large cap funds underperformed the index they were trying to beat. That's right. Only 15% managed to beat the benchmark, and even fewer did it consistently year after year. With passive funds, you don't need to track the news daily, watch fund manager interviews, time the market, switch funds every year. It's set and grow. You simply invest in the market and let it grow over time. Less stress, more peace of mind. Active funds churn your money more often. They buy and sell stocks, creating short-term capital gains. And in India, short-term gains are taxed at 15%. Passive funds rarely change their holdings. That means fewer taxable events and more money stays invested. That's another silent boost to your wealth. With passive funds, you always know what you own. If it's tracking the Nifty 50, you own the top 50 companies in India. That's it, clear and simple. But with active funds, you never really know what the fund manager might buy or when they will sell. It's like giving your money to someone and hoping they make the right call. Why not just trust the market instead? So which fund is right for you? Choose passive funds if you want low cost, long-term growth, less effort in monitoring, and higher tax efficiency. Choose active funds if you can evaluate fund managers, you're okay with the risk, and you can track performance closely. For over 90% of the investors, the answer is simple. It's passive funds all the time without any question. Let's quickly recap why passive fund is better than actively managed mutual fund. It's low cost, it has better long-term results, it is less stressful, it has lower taxes, and it has full transparency. Passive investing isn't boring, it's brilliant. Because in investing, it's not about doing more, it's about doing what works. If you found this video helpful, give it a thumbs up, share it with someone who is confused about mutual funds, and don't forget to subscribe to FinSetWealth for more simple, honest, and powerful financial content. Thanks for watching and happy compounding.